I do want to thank our sponsor, Stocks and Commodities Magazine. We love stocks and commodities. If you haven't gotten your free month, you should get your free month. And I will paste this link in the chat in a little bit. Okay. And again, not again for Vince Fora, Don Fishback. Okay, let's go ahead and kind of get moving on. Don Fishback, just taking a little breath. Don Fishback is like a mad scientist when it comes to trading, particularly option strategies. He's one of the nicest people, very Southern gentleman type of guy. He has some of the smartest methodologies and mentalities that I've seen when it comes to trading options in a non-directional price movement. And so we're going to get him on here. He's going to talk a little bit about how that works. And Don, let's go ahead and see if we can hear you.
I'm tuned in. Can you hear me?
Yay! Good. I saw your mic on and I couldn't hear you, so I was getting a little nervous.
No, I was just being quiet.
Things have been running.
I'm letting you tell everybody how I'm a Southern gentleman mad scientist at the same time.
I think that's a compliment.
Okay. Oh, I'm glad to be here.
Is there different adjectives you'd prefer that I use in the future?
No, that's my mom would be proud of the Southern gentleman, and Terry and Brian and them would be glad about the mad scientist, so I'll take it.
All right, very good. Let me go ahead and get the screen over to you.
Sure.
I will let you know right now that we have had no technical issues, so we're overdue. Fingers crossed.
All right.
Somebody said you're the Mitt Romney of options. I'll introduce you that way from now on.
Well, you know what? Just I don't care what you call me. Just call me.
Okay, it's all yours, man.
Okay. I'm sure Jeff has already told all of you folks about a little bit of disclosure. So we're going to go through some examples and we will use some hypothetical stuff. And I think when I talk about the hypothetical, you're going to go, oh my gosh, how did that person actually do that? But we're going to look at some real world stuff. We're going to look at some hypothetical stuff, and we're going to show you all kinds of things. So at any rate, what we're going to do today is we're going to talk about, it's one of my favorite things, especially for people who are relatively new to options trading. And it's because it's really simple. And when you can either choose to buy options or you can choose to sell options. And you have to think about in terms of, I always like to think of, what can go wrong. I'm the worry ward. I'm more concerned about my losses than I am my profits, because profits tend to take care of themselves. And when you buy options, you never have to worry about some kind of a big blow up suddenly. So this is a really good thing. It's real simple and it's good for beginners. What we're going to do, we're going to look for stocks that are poised for an explosive move. And I'm going to show you exactly how we do it. And there's key advantages to this. It's based on proven research, and we're going to get into that proven research a lot today. And the other thing is it's repeatable. And I don't know how many of you all follow this stuff, but there's what's called a reproducibility crisis. And it's where people publish stuff and then other independent people tried to replicate what was done, and they can't get they just can't repeat what was done in the discussion. And I like to be able to do something that is repeatable. That is, if I talk about it, you can do it at home. Another big advantage is that it doesn't take a lot of time. The analysis is fast, and you don't need to do anything during the trading day. So you can do the analysis during in the period when the market's closed. I mean, you can do it during the day, but more often than not, you want to do it when the market's closed. You do the thing in the morning, and then you walk away. And the other thing that has had a big key advantage is that it doesn't take a lot of money. Some of the trades that we're going to talk about cost as little as $70. It's, again, as I said earlier, it's suitable for most individuals. You don't need to be a pro. And the biggest advantage is that you're going to know why it works. And that's important, because if you don't, I mean, this is just the way I am. And I remember the first time that I bought a trading program. It ran on a Mac Plus back in 1986. And it was the first computer program that I bought, and it gave signals for the futures market. And it gave these signals. But I didn't have the guts to do it because I didn't know why it worked. And so knowing why it works, and by the way, shortly thereafter is when I bought my first copy of MetaStock. I don't know, Jeff hadn't told you all this, but I started working with MetaStock back in 1988. So I've got over 30, is that right? I've got over 30 years of history with this company. So we've known each other a long time, even before Jeff got there. At any rate, you're going to know why it works, and that's going to give you the confidence to actually go out and do this. The nice thing is that we're going to talk about the concept, and it's extremely simple. It's just a 3-step process. And the first step is we're going to find a stock. And I like to think of this as options trading as a business type opportunity. If you look at the Small Business Administration, they basically have the steps to starting a business, and it's to do some research to find an opportunity, and then choose the right strategy, and then do the financial part of it. How much are you going to spend? Well, we're going to do something similar, except we're going to use MetaStock to find a flat stock. So MetaStock is going to do the initial research for us. And then we're going to implement the strategy. So once you find the flat stock, you're going to look for the appropriate option strategy. And then once you find the right strategy, you're going to make sure the price is right. And if everything lines up, then you're going to implement the trade. So 3 steps. And if all 3 steps are good, then you'll actually go out and do it. And I've mentioned that this is in options. And I really like the last conversation. I think it was his name's Jeff Tompkins, and talked about options, and Jeff Gibby has talked about options. Options have gotten extraordinarily popular. Last year, they had the busiest year in history in the U.S. options market. I think it was they eclipsed 5 billion options traded. And so what's the explanation? What's the reason for options becoming so popular? And I think one of the reasons is cost, because it used to be, in fact, it used to be really interesting that there was a trading method, and this is why you constantly have to kind of adapt. There used to be a trading method that people advocated that as a stock got closer and closer to $100, let's say it went from 85 up to 95, the likelihood that it would go from 95 up to 100 would be really high, because there was a belief that once a stock got to $100, they'd split. And nowadays, the stock splits. I mean, you look at Amazon, you look at Google, you look at all these different stocks that they just don't split anymore. And what's happened is now you've got Amazon at $1,600 a share. Well, how many people can go out and buy 100 shares of Amazon, right? So, and I think the last presenter was talking about what you do with 1,000 shares, and that 1,000 shares of Amazon at $1,600 a share, was $1.6 million. And that's why people have made that transition to options, because now you can buy, to get 1,000 shares, control 1,000 shares, you buy 10 options. And so it's this lack of stock splits that has caused options to be so popular. So anyway, we're going to use straddles as our preferred option strategy. And what is a straddle? Well, for those of you who are relatively new to options, A straddle is the simplest strategy designed to profit from a big move up or a big move down. A straddle purchase is the simultaneous purchase of a call and a put with the same strike price and the same options expiration date. And if you're unfamiliar with those terms, I do have good news, because we cover all those topics and many more in the bonus you're getting just for tuning into this broadcast. So when I talk about strike price, calls and puts, and options expiration, we cover all that in the bonus. Anyway, with the straddle, it's a little bit more complicated than just, when I talked about Amazon, you don't just buy Amazon shares hoping that Amazon shares go up. So it's a little bit more complicated than that. You need to select the strike price. And so that's the options expiration price. And the one that we want to choose is the strike price or expiration price that's closest to the current stock price. So if the stock is $51 and they only have strikes at 50 and 55 and 60, then you want to choose the 50 strike. So you want to choose the strike price that's closest to the stock price. And the expiration, we suggest you do some testing to see which one you find is best. But what I want you to consider, not just the timing of the system, what does the system say, but make sure it suits your personality. Do you want a short-term option or a long-term option? And the reason I say that is because options deteriorate in value. They have this component called time value. And time value deteriorates every day. But the rate at which it deteriorates varies depending on the amount of life left in the option. The longer the option term, the slower the time value deteriorates. As you get closer and closer to expiration, that time value deterioration speeds up. And it's really important that if you're somebody that does not like a lot of risk, then you might want a longer term option. If you're comfortable with the risk, then you can go with a shorter term option, because you're paying less, but you're getting a little bit more risk when you use a short term option. Okay, and this is what a profit loss of a straddle looks like, and it has a maximum risk, so you know how much money you're risking. And the risk is limited to the amount that you paid to buy the two options. Now, it does not have a maximum profit. Of course, the stock can only go down to zero, so there's a maximum profit on the downside. But on the upside, there's really an unlimited profit potential. And we can calculate the break-even price, and you can see if it goes up, you're going to make money. If it goes down, you're going to make money. This is a neutral trade. So all you're looking for is the stock to move beyond that upper break-even price or that lower break-even price. And so this is why it's perfectly suited to a situation where you expect an explosive move up or down when you're unsure about the direction. So straddles, they're a pure volatility play. They do not depend on direction. They only depend on the size of the move over a certain period of time. So that's what volatility is. So straddles, they're not high probability trades. Straddles tend to lose more often than they win if you're not using a system. Buying straddles without a systematic method tends to be a money-losing endeavor. In fact, we can measure how much money you lose. And so I've done something that very few people have done recently. I've measured the performance of S&P 500 index straddles, so that if you just blindly every month, so the third Friday of the month is option expiration. If you bought an S&P 500 straddle and held it to the next month, and then on that expiration, you bought an S&P 500 straddle and held it to the next month, and then so on and so forth. If you did that month after month after month after month, and we're looking back over a 20-year period, you'd lose on average 8.1% per month, which is terrible. In fact, here is a graph showing the cumulative returns added together. And you can see it going back to 1998. It's just been on a persistent downtrend with a few blips higher every now and then. So that's the realities of straddles. So why use straddles then? If performance is so poor, why even bother implementing them? Well, because I mean, as you can see, the statistics, they imply that traders tend to overestimate the volatility, that size of the movement over time. They tend to overestimate the volatility most of the time. Well, why use straddles? Because in certain key situations, the opposite occurs. Traders tend to underestimate volatility. So most of the time they overestimate it, but in certain situations they underestimate it. And that's when you have an opportunity. So when do traders underestimate volatility? They underestimate volatility when stocks go flat for no fundamental reason at all. And this is an example. This is a chart that is produced in MetaStock. This is from just a few weeks ago. This is Dollar Tree, and this is using the MetaStock add-in, the odds compression add-in. And if you look over there on the very right side of the chart, you can see where there's a little diamond and an OVC. And what we've identified here is a period where Dollar Tree shares got extremely compressed. So you can see as the range has gotten narrower and narrower, and they've compressed. And if you want to think of it as a coiled spring, and somebody has just taken a spring and just pressed it and pressed it and pressed it to the point that it is just so compressed. And then once you release the spring, that happens. And the stock makes a very large move. The thing is, we don't know the direction because it's like the coiled spring. Which way is it going to bust out? We don't know. But this is what tends to happen more often than not. So how do we measure that flat? Because obviously you've got those signals. Let's go back here. You've got two of those OVC, the odds volatility compression signals there in December. Well, what constitutes that? What triggered those signals? And I observed, I was just playing around with MetaStock a few years ago, several years ago, actually. And the nice thing about MetaStock is that they have these chart templates that you can use that other people like myself, or in this case, it was Daryl Guppy. He has something called an MMA template. And this is what we're looking at right there. So this is the Daryl Guppy MMA template. And you can see when everything starts to converge to one particular point, that's when you've got that compression right there. And what tends to happen more often than not is that the stock is going to make a big move up or down. So how do we measure that convergence? So I created an indicator that measures convergence, and I've included it in our MetaStock add-in. And the indicator is called the odds compression ratio. And the add-in actually includes an expert that provides the signals, exploration capabilities, and expert commentary to kind of give you some guidance on what to do. So the signal, that OVC, that little diamond, what happens? So when the odds volatility compression ratio hits an extremely low level to the point where the moving averages have converged, where they're just really concentrated, the asset is considered extremely compressed. And at that point, the stock is more likely than not to break out of the odds volatility cone. And if odds probability cone, and I don't know if you folks are aware, but if you go over here into this little bar over here on the left, you see this right there. That's the odds probability cone. It's been a tool in MetaStock for over 20 years now. And what it does is, you can see there's other brokerage platforms like Thinkorswim has this now. I think E-Trade now has this. I was the pioneer. MetaStock was the pioneer that put this in software before anybody had it. And what it does is it takes volatility, and from the volatility, it projects out a likely range based on whatever probability you input. So in this instance, we got the signal. This one is Old Dominion. This is Old Dominion Freight Lines, and you got a signal right there. And so this is a 1 standard deviation band. So about 2/3 of the time, the stock should stay within this range right here. And you get a signal, and it just is more likely to break out of that range more often than not when you get that compression signal. So when you get that compression signal, you want to buy a straddle. So the next part is, it's like, okay, you found a stock, Dollar Tree and Old Dominion, and you put on a straddle, and it's the at the money straddle. But what price? What's the what price should you do? And that's what this next section is about. But before we do that, we're going to talk a little bit about probability, because everybody talks about risk and reward in trading, right? And if all we wanted to do, making money, was only about risk and reward, then every single one of us should go out and buy lottery tickets when that reward gets gigantic, when those jackpots get huge. But there's a reason we don't do that. And the reason is the probability of winning the jackpot is so remote. And so that, at the other end of the spectrum, if you say, well, probability is the only thing I want to worry about, well, then go buy a T-bill, right? That's probably one of the lowest risk things you could buy as an investment, a CD, bank CD, a T-bill, something like that. But then you're risking $100,000 to make $1,000 over the course of a year. Well, what's the likelihood you're going to lose 100,000? It's not that much. The United States government bankrupt in the next 3 months. But those are the extremes where you have absolute certain risk, absolute certain reward with the T-bill, but the yield is real low. And then the other one is almost no chance of reward, but that reward potential is still real high compared to the risk that you're putting on. So we're going to talk a little bit about probability, and in particular probability and how it impacts straddles. So this is black-scholes, and this is the most common method of valuing options still. Black-scholes was around back in, developed in the 60s and got published in the early 70s. And so this is a partial differential equation. And when you solve that, you get the actual formula. And I have 2 arrows that are pointing to N. And the N is important because N is actually a probability. So this is the Black-Scholes way of looking at probability. You've got a bell curve. So hopefully a lot of you are familiar with the bell curve. And N is the area under the bell curve to the left of X. So let's say, I'm going to go back to Black-Scholes. Let's say that D1. Let's say D1 is equal to 1. Well, this is what D1 would represent. It's the area under the bell curve to the left of 1 standard deviation. So your x-axis is standard deviations. And so N of 1 is the area under the bell curve to the left of 1. And that's about 84%. So the area under the bell curve to the left of 1 is about 84%. The area to the right is about 16%. Well, it's used as an assumption. That's the key assumption in the Black-Scholes model. So why do they use it? Well, you can see right here. This is the S&P 500 distribution from 1952 to 2018. And I chose 1952 in particular because prior to that, there was weekend trading. So since May of 1952, there's been no weekend trading. So the white line you can see, that is the theoretical distribution. Those columns that you see, that's the actual movement of the market. So you can see it's a really close approximation. I mean, they fit pretty daggone close. But there is a flaw, and the flaw is that even though the black-scholes formula is still around, and this is, by the way, Fisher Black, who was the co-creator of the black-scholes. The black-scholes formula is still around, even though it depends on at least 10 unrealistic assumptions. Well, that's a pretty shocking admission from the guy who actually created the thing. And Jack Schwager, who wrote a great book called Stock Market Wizards. He wrote Market Wizards and Stock Market Wizards in 2001. In his book, Jack writes, the very idea that any single model could be used to estimate option prices for different markets or stocks is inherently wrong. And what did he mean by that? Well, this is what happens. This is an actual, this is from a spreadsheet that I created in May of 1996. And you can see so the orange line is a theoretical, and the blue line is what actually happened in the market. And you can see those blue columns in the middle just absolutely skyrocketed higher. And what it's measuring is the price fluctuation. So it's literally counting. If you look at the y-axis over there on the left, and it goes 0, 5, 10, 15, 20, 25, 30. So this column right here in the middle, 30 times over the last year, the market barely moved. And then over here, 35 times the market moved up just a little bit. And right here, 10 times the market, and this is a one-day thing, 10 times the market moved up about 0.9%. So that's, I mean, you're just counting. It's like, how many times did the market move up? How many times did the market move up 2.8% in a day? How many times did it move down 4.1% in a day? And so you're literally just counting. So you're projecting it on top of what the theoretical expectation is. And you can see that in reality, the market had a bunch more small moves than the theoretical model expected. Well, that's one way to look at it. It's a very much improved way to view probability. And again, this is something that I created back in 1996. Well, this is Bloomberg in 2018. And you can see Bloomberg has decided to adopt the same methodology that I developed 23 years ago. And they call this HRH, for historical return histogram. And it shows basically the same type of information. And Jeff was talking about the MetaStock Zenith from Refinitiv. This is just got this a couple days ago, or just created this chart a couple days ago. But Refinitiv, the MetaStock Zenith, gives you the capability of doing the same thing. They call it historical return analysis. You can see that right up here, historical return analysis. And so so this is from May 2017 to May 2018. So you're looking at a 1-year period, and this was the same thing, May 2017 to May 2018. And so I wanted to make sure that these things were all similar. And you can see, I mean, you're just counting, but it gives you an accurate portrayal of what the actual movement of the stock is compared to what the option pricing model is implying. The option pricing model implies that bell curve, but the actual movement is substantially different than that. Well, so you're getting a different distribution for each market, each stock, and for each time period. So that basically solves one of those issues that Schwager wrote about in stock market wizards, and it fixes one of the assumptions that Black talked about when he talked about some of the unrealistic assumptions. But even this method contains flaws. And one of the flaws is a timing mismatch. And what I mean by that is you're looking at a one-day move. So that's what those charts were looking at, one-day moves. Well, when I put on a trade, it might have 5 days, or it might have 17 days, or it might have 43 days left of life left. So you're not getting a timing mismatch. You can look at it 1 day, 1 week, 1 month, but you're getting the timing mismatch, because if your trade expires on something other than 1 day, 1 week, 1 month, it's not lined up. The other thing is something called autocorrelation. If you solve the timing mismatch, which you can solve the timing mismatch, but when you do that, you get something called autocorrelation errors, and that's basically where one value is dependent upon the prior value. So we don't want either one of those. So is there a solution? And there is. We call it measure, don't model, and it solves those problems. So let's get into that. And the nice thing about the measure, don't model, it provides an all new way to value options. So we're going to use a real world example from a trade that we did just recently in Allegheny Technologies, ticker symbol ATI. And so here is what it's going to look like in MetaStock. So this is the MetaStock, and you notice I have the Explorer open right over here. I've got Explorer open, and I have checked the odds, volatility, compression. This is the exploration that comes with the add-in. And what we're going to do is we're going to select US optionable stocks. So these are all the stocks in the United States that are optionable, and you can see there's 4,344 of them that are available for trading. I'll tell you this right now, there may be 4,344 of them that are available for trading, but there's only about 1,000 of them that actually have liquid markets. So many of them are horribly illiquid. They may be listed, but they're not suitable for trading. And we'll show you a way to get around how to make that kind of determination. We run the exploration, and needless to say, in the middle of November, there were not too many stocks that were that flat. We had just had a big sell-off in October, and so the stocks were pretty agitated and had a lot of volatility at that point. They got even more agitated in December, but they got pretty agitated in November, and so there weren't a lot of them that were flat. But here's one that was Allegheny Technology. And here is a chart of Allegheny Technology. And if you look at here. Look at the moving averages. I mean, they are all converging right at that 27, right near that $27 range, right in there. And so this is the compression ratio right here, this line right there. And then what this little line right here, there's where we got a signal right there. So basically this compression ratio fell to an extremely low level, and it popped out a signal and told us that the odds, volatility, compression criteria had been satisfied. And you can also see that it painted the bar blue so that it sticks out. So once we've done that, we then use the distribution that is specific to the stock to value the options. And so here is the stock distribution, and you can see the bell curve is that orange line. And these represent the actual movement of the stock. And so these are the small moves here, and these are the large moves down, and these represent the large moves up. And so you can see it has fewer small moves than is expected by by the Black-Scholes model, and it has many more large moves than is expected. So they've got the options priced for small moves, and Allegheny Technologies actually has a history of making large moves. So that's what's going on right here. And then we can analyze these straddles on compressed stocks using our software Odds Online. And you can see right here, this is the ask price of the option right there of 1.3. And you've got the ask price on, so these are the calls over on this side. The ask price is 1.3, the puts are over here, and the ask price on the put is 1.8. But the value right there, Fishback option value, is 1.7 and 2.3. So we've, here, let's zoom in on that. 1.3 and 1.8. So you add those, so you're buying one and buying the other. You add them together, you get what, 3.1. And over here, the value is 1.7 versus 2.3. So you've got 3.1 in the price, and the value is 4. So the price is much less than value. And that's how Warren Buffett made all his money, right? Buying stuff less than value. So that's a good thing. Your price is less than the value. And the software makes it pretty easy. It's you pay shows you the 3.1 versus the 4. So you can do it by hand if you want to, but the software actually makes it really easy to do it. And this is what it looks like in a profit loss chart. So this is what the straddle looks like. And then this is what actually happened. We have the ability to look back and say, it's like, all right, I want to save the trade. And then you say, all right, I want to look at it if from prior history, or from the start date through the history. And you can see that the option strategy lost a little bit money, but then there was an announcement, the catalyst came along and the stock shot higher. And when it shot higher, the straddle made a lot of money. Did very nice. So I heard Mr. Tompkins earlier talking about cherry picking, right? So that was a good trade. But what does it look like if we do all trades? And it's important to not just look at it's like, okay, this did well, but let's look at the benchmark, because somebody could say, well, in 2017, we made 20% on our money. Well, the S&P 500 was up 31%. So who cares, right? So we need to look at the benchmark first. So we're going to look at benchmarks. Then we're going to investigate to see if the compression signals improve on the benchmarks. And then we'll see if the value improves on the benchmarks. And then we'll see if the combination of signals and value improve on things, and if so, by how much. And earlier I talked about hypothetical. Well, here's what we're talking about. What we did, and we've got a database unlike any other in the options industry. We've got a database going back many, many years, and it has the performance of every single option ever. I mean, I'm not most of them or some of them, all of them ever. And so what we did was and if you look over there on the very far right what we did was we said for every stock option, no index or ETF, for every stock that was available for trading, we are going to buy a at the money call on option expiration day, and then we're going to hold it till the next expiration. And then we're going to do it again and again and again. So there were almost 10,000 calls that we looked at, 10,000 puts, and 10,000 straddles. And then the next year we did the same thing, and again and again and again. So we tracked the performance of 184,437 trades. And then we measured how did they do. And you can see that if you had a wallet that was big enough, and you blindly bought every single call you possibly could at the money call, 1 month, what's 1 month in duration. If you bought all of them and held it to option expiration, how much money would you have made over the course of 15 years? Your average return would be about 2%. But if you did the puts, you'd actually lose about 24.7%. And if you bought the straddle, you'd lose about 10.2%, which is not too far off from what we looked at with the index options that we were talking about earlier. So the benchmark on a straddle is actually a loss. The average, so over 184,000 options, your average loss is about 10%. So again, we did all signals for all stocks during the 12-year period. Well, actually, it's 15-year period. I changed that. 15-year period. We used equity options, no index or ETF. We created straddles for each signal. And then we looked at the trade duration. We looked at a trade duration of 21 days, 49 days. And it ended up being about 5,400 straddles that we looked at, because again, we're only looking after the signal. We're looking at the straddle performance after a signal, not just the whole aggregate. And our exit was very simple. We're going to assume that you held to expiration. And then what we did was we calculated the return for each one of the trades, and then we calculated the average return of all trades. And you can see right here, we earned these signals. So the average profit of all equity straddles after a compression signal with no value considered was 2.3% per month, 31% per year. Now, so the benchmark was a loss of 10.2% per month. And by using nothing but the signals, you went from minus 10.2% per month up to 2.3% per month. So the signals definitely worked. It improved things a lot. Did it get it to a level that you're saying, oh my gosh, I can't wait to do this? I don't know about that, but it definitely improved things. So now we can say that the signals improved performance. But what about value? Well, again, we took those 184,000 straddles and we calculated the price versus the value ratio for each one. And then we sorted them and split them up into 10 groups. They're called deciles based on that ratio. And then we assessed the performance of each straddle, again, assuming that we held them until expiration. And then we calculated the average performance of each decile. And you can see the cheap options did well and the expensive straddles did poorly. And this is something it's what's known as monotonic in the academic circles, in the mad scientist circles. And this is something that is really desirable when you have something. It shows that there's no aberrations where one's just sort of like just coincidentally is doing well. It shows a clear trend that the value is an important factor in determining the profits versus the losses in straddle returns. So value clearly improves performance. So now what we're going to do is we're going to apply value to straddles on stocks that have a compression signal. And now we've got this. And so if you look at the left side of the chart, that's the return on stocks where you get a compression signal. So the stock is compressed and the options are cheap. And in that instance, the return is 22.9% per month. That's 23% a month. Now that's really good, folks. 23% a month is it's 1,000%, over 1,000% annualized return. And again, you can see it is clearly leaning towards a monotonic distribution right there. So by selecting only those straddles where the stock is compressed and the option prices are below value, you turn a strategy that tends to lose. Remember, straddles tend to lose 10.2% a month. by selecting the ones that are compressed and where the option prices are below value, you turn a strategy that tends to lose into one that tends to win. So that's what we are able to do. So here are the rules. Again, there's a real simple set of rules. You're going to use MetaStock Explorer and the odds compression add-in to find stocks that are compressed. And then you're going to analyze straddles on the compressed stocks, and you're going to screen for straddles where the price is less than the value. And you can do that through our software. And then you're going to implement straddles on compressed stocks when the straddle price is significantly below value. And then we're going to the exit strategy, right? Because that's where you make your money. It's the easiest exit strategy ever. You're just going to hold it till expiration. Now, the one thing I do want to mention is that you need to be sure to exit the in the money, because when you put one of these things on, one or the other is going to be in the money. The stock is either going to go up or go down. It's very rare that the stock, if let's say you buy the 50 call and put, it's very rare for the stock to finish right at 50. So if it's above or below that 50 strike price, one of them is going to be in the money, and you need to exit before the market closes on options expiration day. So with that, I don't have much else to say other than I'll take some questions.
Would you like me to help with that, Don?
No.
All right.
Actually, I would.
Okay. Okay. Let's see. Sanjay wants to know if you exit the day before the expiration.
We tend to let it ride. Believe it or not, I tend to let it ride until about 3:45 p.m. on option expiration day.
Xavier says hello.
Hello, Xavier.
Let's see. Have you tried buying straddles one day before stocks announce its earning report?
That's a really I have not, and I'll tell you the reason why. That that is a really this concept, and I'm sure a lot of people have heard of this concept. It's called herding behavior, and it's like when a lot of people start doing the same thing. When a lot of people start doing the same thing, the opportunity for profit. You know, you make money by when other people get it wrong in options. It's not like a stock where you can buy a stock at $50 and the stock goes up to 60. It doesn't mean that a bunch of people have lost money, but with options, it's a zero sum game. And so you get this herding behavior that a lot of people start duplicating the same thing, and those profit opportunities disappear. That is, you don't have an edge. So you've got to get an edge in options because it's a zero sum game. And I'll give you a perfect example. I was talking about this with some customers just the other day. The most expensive real estate transaction in the United States history just took place, where Ken Griffin just bought a condo up in New York for $220 million. Well, Ken actually owns one of the biggest option market making firms in the planet. And he actually bought, if anybody's seen Nigerian on CNBC, Ken Griffin bought Nigerian's firm years ago. When you trade options, you're not going up against people, other individuals in almost all circumstances. You're going up against market makers. And that means you're going up against a guy who just paid $220 million for a condo up in New York. So you need to find an edge over that guy. And it's really, really hard to find. And so think about it. Do you think a guy that can buy a $220 million condo doesn't know that Apple's coming out with earnings or Amazon's coming out with earnings? They've usually got those options priced right. So it's really because everybody knows about it. So finding an edge on option expiration on earnings day is really, really difficult. So I don't do it.
Is there, from Brett, is there a minimum sized account you would recommend to take the majority of the trades?
Um, no, well, to take a majority of the trades,
Mhm.
the probably, I mean, you probably made about $3,000 to $5,000 to take a majority of them. I mean, usually, so the average size trade for one contract call, one contract put is going to be about $400 to $500. And we don't have a lot of overlapping trades. You might have 3 to 4 positions on at a time, but you definitely want to have some capital in your account sitting there so that you're not overextended and have all of them you don't want to put something on where they all go wrong and not be able to recover from that. So probably about $5,000. It's much more likely that you're going to have to meet a broker minimum requirement than you are have an account size restriction based on the number of trades. I will say this: if you do get a trade, if you find a trade in Amazon, you find a trade in Google, those are going to be expensive. And if you have a small account, you're probably going to have to take a pass on them.
Another question. If you buy odds for MetaStock, do you receive access to odds online? No. But
Yeah,
if you have a URL we can give people, I'd recommend you take a look at it.
yeah,
It's
I
one of the
will.
best calculators I've seen. So
Yeah, that's a good point. I'll put that up right there. It's oddsonline.com. And to everybody that's watching, we will be sending out an email, and we will be offering a special discount. We're actually going to be conducting a webinar on odds online later next week. So everybody will be invited to come to that and hear more about the software. I mean, it's really, I agree with you completely that it's the best options calculator out there. Thank you.
Guna, and I'm sure I just mispronounced that as poorly as you can, but he says awesome explanation from stock splits to trading and no weekend trading from 1952. Good strategy as well. Thank you.
Thank you.
Daniel says, do you have any recent trade examples?
Well, let's see, we've got the Dollar Tree and we've got the ATI. I showed that one. Um, Now, so there's two things. First off, you have to find a flat stock, right? So finding a flat stock the last couple of weeks has been next. We haven't had a lot of activity the last couple of weeks. I don't have anything right off the top of my head, Jeff. I wasn't prepared to answer that question.
Okay, no problem. An honest answer is always the best one, right? Let's see. Somebody wants a brief explanation of what it means when an option is in the money. I could take that one for you.
Please.
Okay, so an option that's in the money just means that, well, for example, it has intrinsic value. So if you have an option to buy a stock at 25 and it's trading at 26, it would be considered in the money because you can sell it at that point for just intrinsic value.
That's right.
Woohoo! Let's see.
You've gotten good at this, Jeff.
I've done a few options trades in my day. Zususu says, can I get a recording of this webinar? Yes, we will send a recording. It's about 8 hours of audio and video. We like to break it up and put it up on our YouTube and do some editing on it. So I will email you when it's available Wednesday or next week sometime, usually by Wednesday. Let's see, will Odds Online cover the same list of US stocks?
Absolutely. Yes. Yeah. We cover the entire options universe. The one thing that we do extra is that we provide, it's nice. We have these little liquidity flags so that if the if the options are illiquid, we give a little warning sign. We also, I mean, our business is options, right? Much more so, where MetaStock has capabilities, in unbelievable capabilities that, and I heard you talking about Zenith. I absolutely love Zenith, but MetaStock and Zenith have capabilities that we don't have. On the other hand, our software has capabilities that MetaStock doesn't have. So when you go into let me just bring this up real quick. All right,
While you're doing that,
this is called an option chain,
okay.
and in whether it's Zenith, so you can get an option chain like this in Zenith, right? But what we can do, let's say there's a split or a special dividend, or there's an acquisition or a spinoff or something like that that's going to impact the stock price. What we will actually do, where the option value is in this column right here, we'll pull that out, and we will put in a link that takes you to something called an info memo. So you can click on that and actually see that there's a corporate event that's going to impact the stock and those options going forward. So it's a really valuable tool. We just do options. I mean, that's our specialty. I've been doing this, got started in 1984, started my own company on options in 1993. So we've been in business for over 25 years. We have my book, Options for Beginners, well over 100,000 people, and all the money from the sale of Options for Beginners, all the profits have gone to charity. In fact, we just donated $3,000, I think $2,500 to the American Heart Association last night. So that's just this is what we do.
All right, 3 quick questions left. Coverage for Canadian stocks?
We do not cover Canadian stocks. We are U.S. based only.
Okay. And of course, though, you can scan for Canadian and UK markets as well in MetaStock, but obviously not in the odds online service.
That's
so
right.
Let's see. Sanjay says, do you specialize in any other strategies or just straddles?
Oh no, we do credit spreads. We do a lot of credit spreads. We do a lot of put selling. So that's, yeah, we do other strategies. I mean, the software can do anything. I mean, it'll scan for collars, it'll scan for iron condors, straddles, debit spreads, credit spreads, and then those are and covered calls, just everything, plain old buy call, buy put. But while we focus the software actually go out and find the trades for you. I haven't shown you that. The software will actually go out and find. So you type in a ticker symbol and say, I want to find a straddle on it. It'll go out and find the right one. But you can build your own. I mean, you can build anything you want in the software, and you can store it. You can say, all right, I want to save it and compare it to another one, which is something nobody else has, where you can compare trades side by side. So it's got a lot of, just scratching the surface.
Okay, another question, and we're going to do 2 more. Ed, Sanjay said, thank you, by the way, great. Ed says, do you have any live seminars in Chicago coming this year? I hear it's really nice in Chicago right now, like minus 150 degrees or so.
Well, I have a daughter in Chicago, and it's actually warmed up, but yeah, it got pretty darn cold. I remember, I'm telling you, all right, I've got to go off a little bit of a tangent. There was Futures Magazine used to have these seminars in Chicago in January, and we told them, "Are you people nuts?" So they started conducting them down in Orlando in January. So no, I don't have anything scheduled for Chicago, but we are looking for a live seminar event sometime in 2019. We're just trying to decide where, and we're in the decision-making process on that.
What about pending earnings reports and their impact on potential straddle play?
Yeah, that's a great question. Again, you've got to be aware that everybody knows the earnings report is coming out. So if it's very rare, it's extremely rare that you find cheap straddles going into an earnings report, because the market makers that are pretty darn smart enough to be able to afford the richest real estate in the United States, I think of the United States, they're pretty good at this. And so when they see, Google's going to come out with earnings next week, well, guess what? The Google options are priced for such an expectation. But every now and then something slips by. So you're never going to find one on Google or Apple or something like that, but you might find one on an obscure stock. And but you just need to be sure to check the option value. And there's a chart that you can use in the software. It's called a term structure chart. And when the term structure gets inverted, it's usually because the market makers and the other traders know an event is coming. So you can look at the term structure chart and get an idea if the options are priced right.
All right. I think we need to move on.
I think you do. Thanks for your time.
Okay. Thank you, Don. Great job today. Let's go ahead and kind of switch the presentation back here. I will show we're a little bit more relaxed because I'm next anyway. So I'm not as worried about kind of cutting into my own time. I'm totally fine cutting into my own time. I will show you kind of the results of the exploration and kind of how that worked. I already ran it, so I'm all ready to go. Here's an example of the chart and the way that kind of looks like. Really what the idea is to find the stock that's most compressed, as Don was saying. Okay.
Yeah, now can I say something about that?
Mm-hmm.
That is one situation where you want to check the news, because what's happened right there, that stock is cheap for a fundamental reason. Somebody said, I want to buy A. Schulman for about $44, $45 a share. So the stock immediately, so you can see that gap in February.
Mm-hmm.
And so the stock gapped in February and then went pancake flat after that. So it went up to what, about 43, and then you can see it started to trickle down into May, and then they might have gotten a higher bid, or something happened to draw it back up towards 44 and a half. So that's what's happened right there. That's a stock that's gone flat for a fundamental reason. So I'm glad you brought that up, Jeff, because you do need to check the news to find out, why is the stock flat. And if you see something like that, that's an immediate tell that the stock is flat because it's getting taken over.
And it might have already been, because I swear I updated this folder before I ran the scan, and the last date on it is August. So something may have happened with this particular stock, or I didn't run the scan right. But I did run the scan against all of the U.S. optionable stocks on a local list, and I did that very much on purpose because it is extremely selective. You are looking for the lowest value, the lowest volatility value in 200 days, if I remember that right, Don.
Yes.
So,
4 years.
Oh, in 4 years. Yeah. Okay. I knew it was a long time. In any case, this is kind of the list that comes out. So it's extremely selective. And let's just see. I'm going to open up a different chart real quick and just see where that data goes to. And yeah, something did happen to that stock. It's no longer even trading. This one is obviously more up to date. Doesn't look that much better to me, but there you go.
But you know what? It's really compressed. I mean, compared to prior history, it is really getting concentrated on that 3250 range, right in that neighborhood. It's which is interesting.
I love the non-directional approach that you take to things, Don. So now you got me
curious. But I'm gonna get, as soon as I get off, I'm gonna get into odds online and price those options.
Okay. There's another one that came up on the scan today that you can look at too. Okay. It is Theravan.
Yeah.
Probably already seen it. Awesome. Well, there you go. Thank you, Don. I'll talk a little bit about the add-on, and then we'll kind of roll into the kind of the presentation. I'm going to show you a couple of things about MetaStock. So, Don, really appreciate your time today.
You're welcome. I enjoyed it.
Great job,
As
as
always.
always.
All
Okay,
right. Bye
thanks,
now.
man. All right. So there we go. Let's kind of go back. Again, a very kind of intuitive, non-directional volatility approach to trading options. Normally, that's $3.99. It's $2.99 here at the summit. I meant to kind of correct that slide, but $2.99 here at the summit. It is part of our Traders Toolbox, where we're going to include Steve Bigelow, Vince Vora's Veracity, the trade trend, and then the Don Fishback Dodds compression. Normally, all of those would cost you about $31.63. Off 4 of them, you'll get that 2 years of access to Stocks and Commodities magazine, 3 months of access to the MetaStock Real-Time, 3 months access to Refinitiv Zenith, the Unleash the Power of MetaStock, my special February 13th, 4 p.m. Eastern Time bootcamp presentation to help you get started with the software. Normally, all of that would cost you $4,159, but here at the summit, it's $1,733. And I want to thank all of you that have already ordered. I really appreciate it. And if you have any questions as we get started, or you can give us a call, 800-882-3040, or you can visit us online at metastock.com/salespchat. Again, I want to thank the sponsor of today's event, Stocks and Commodities Magazine. They did a great job of helping us promote the event. They've been supporting it since the very beginning of it 6 years ago. And they are offering that 2 free year subscription or just a free issue as well. So there you go.